Imagine waking up tomorrow and your gas price jumps 30% overnight. Your grocery bill spikes, flights double in price, and the stock market suddenly drops trillions. That's not speculation. It's already starting. Because the Iran war just triggered one of the biggest financial chain reactions in years. Oil tankers are stuck, energy prices are exploding, and investors worldwide are scrambling to reposition. But here's the twist. While most people panic, smart investors are quietly making a very specific move. And if you understand it early, you might turn this crisis into an opportunity. To understand the scale of this event, you need to look at one place on the map: the Strait of Hormuz. It's a narrow waterway between Iran and Oman, but it carries about 20% of the world's oil supply. Now imagine that artery suddenly getting blocked. Tankers stop moving, insurance rates explode, and global oil supply instantly tightens. That's exactly what markets are pricing in right now. Some analysts say oil could surge past $100, even $150 per barrel if the conflict escalates. And when oil spikes, everything else moves with it. Most people think wars affect stocks directly. They don't. Oil is the real domino. Here's why. Oil powers almost everything: transportation, manufacturing, food supply chains, air travel, shipping. So when oil rises, companies pay more. Shipping costs surge. Inflation spikes again. That's the nightmare scenario economists call war-driven inflation. And if inflation rises again, central banks can't cut interest rates, which means mortgages stay expensive, credit cards stay expensive, and markets get nervous. When geopolitical shocks happen, markets follow a predictable pattern. First domino: oil spikes. Second domino: inflation fears return. Third domino: interest rates stay higher. Fourth domino: stocks reprice. And suddenly, trillions of dollars move across markets. History shows this pattern again and again. During major Middle East conflicts, oil surges, stocks wobble, gold rises, defensive assets outperform. Because uncertainty is the one thing markets hate the most. While the public focuses on headlines, professional investors are quietly repositioning. They're doing three main things. First, they are moving into energy. When oil spikes, energy companies often become huge winners. Think oil producers, pipeline companies, and energy infrastructure. Their profits can explode when crude prices rise. And historically, energy stocks tend to outperform during oil shocks. Second, they are buying safe havens. When geopolitical risk rises, investors look for protection. The classic safe havens are gold, the US dollar, and government bonds. Gold especially tends to surge during geopolitical uncertainty because investors view it as a store of value. That's why gold often rallies during wars and crises. Third, they are rotating into defense stocks. Another surprising winner during geopolitical crises is defense companies. When conflicts escalate, governments increase military spending, which boosts revenues for companies that produce missiles, defense technology, and aerospace systems. That's why defense stocks historically spike during global conflicts. But here's something interesting. The biggest market opportunities don't happen during the panic. They happen after the panic, because markets often overreact. History shows that geopolitical shocks cause short-term volatility, but they rarely cause long-term crashes. Markets eventually adapt. Supply chains reroute. Energy production adjusts. And prices stabilize. Which means investors who stay calm often outperform those who panic. The real danger isn't the war itself. It's the second-order effects. For example, if oil stays above $100, inflation could surge again. And if inflation surges, central banks may delay rate cuts. That could keep mortgage rates high, credit expensive, and stock valuations under pressure. And that's where the real economic slowdown could begin. There's one asset class investors are watching very closely right now: energy. Because if supply disruptions continue, oil could become the most powerful trade of the decade. Some analysts believe a prolonged conflict could create a new global energy supercycle, and that would reshape markets for years. The Iran war isn't just a geopolitical story. It's a financial shockwave. Oil markets are reacting. Inflation risks are rising. And investors are repositioning billions of dollars. But the smartest investors understand one thing: markets don't reward panic. They reward preparation. Because every crisis also creates opportunity. The real question now isn't whether markets will react. They already have. The real question is what happens next. Because if this conflict spreads, the next move in oil, gold and stocks could be much bigger than anyone expects. And the investors who position early could benefit the most.